Hello, this is Eric Boyce, President, CEO, and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for June 30th of 2024. Okay, so we're going to start the chart pack off with comments on our budget at the federal level. We just had our first presidential debate, and say what you will about how you felt like that went. The issues are still at hand, right? And so there's other things where we don't get into in this kind of charts and chat, like immigration, stuff like that, that are clearly in the national forum, but we will talk about the fiscal situation. Because I think that is going to be a recurring theme, and I think it's going to become more acute as we go along, because it's clear that both sides are very profligate in spending, and they're very tone deaf and agnostic as to the fiscal responsibility element of running a government. And so you can see here on the left-hand side the 2024 budget at the federal level. You've got on the left-hand side, you've got spending. So you have the entitlement spending, which we're all very well aware of, Medicare, Social Security. You can see that that is basically 33% or a third of the total budget. And that's only going to increase. We've got net interest, which is about $900 billion. The total interest outlay is probably closer to $1 trillion, but you net out kind of intra-governmental transfers, and such. And so you get down to about $900 billion. And then you got national defense there, about another 13%. There a lot of research has been written. When you get to net interest cost, which exceeds national defense, that tends to lead to slower overall economic growth. And we know that government outlays for defense, being the leader of the free world, have clearly driven a lot of government-related spending. And that is really set to continue. So the question is, where do you pinch that? You got that big other category, which has a lot of kind of essential spend, and there's a lot that goes into that, but a lot of it is non-discretionary. And then on the right-hand side, you got basically borrowing about $1.8 trillion to shore up the budget, and that's the problem here. So we've got 26% of the overall spending that needs to be borrowed to sustain, and so we get these fiscal deficits, and that's become a real issue, and nobody seems to really care about that. And that tends to, well, not tend to, but it will slow growth going forward if the government's participation, and government is definitely a participant in our GDP figure to the tune of, anywhere between 12 to 15%. And if that really begins to curb, then that's going to have a meaningful impact on GDP. And you can see here on the right-hand side, net interest cost as a percent of total federal revenues. You can see how that has gone up over time, expected to remain pretty high. And so really, as interest rates stay higher for longer, even if they come off the peak here, that's going to be an anchor on the overall federal deficit. You've got basically a gap there that's going to need to be made up for in some level of borrowing, which is going to further our national debt, further our further our budget deficits, and so on and so forth over the next several years. Next, we have a chart here from Bloomberg here, tracking the moving average for the unemployment rate, and you can see various inflection points here as we look at this time series. It goes back to basically the early 60s, late 50s here. And you can see very clearly inflection points, which we're basically at another one. We've got the black line, which represents the unemployment rate in percentage terms. And obviously that's very low, but it is coming off of its trough there, but you can see the moving average on it's a three-year moving average, and as those numbers have come down, I think there is a bit of noise just because the pandemic was such a dislocation to the norm, as you can see very clearly here in this chart right here. But as we've kind of like that moving average kind of rolls over and we're kind of punching through it, these are times that tend to follow periods of slower economic growth. And so this is going to be one of the many charts that we look at to say, listen, if we have an economic slowdown and things and GDP doesn't grow nearly as fast, then these are things that we'll look at and say, you know what, we saw the signals. Here we have household budget over the last 3 months, and some of the things that kind of caught my eye here. This is from Arbor Research, and it just basically shows you the percent of these different age cohorts that are thinking about these types of budgetary decisions in their own lives. And I think this is pretty interesting. You've got quite a few people in all age cohorts that are cutting back on just overall discretionary spending, and then you have other things like canceled memberships and reduced digital services. And, then you have over here, you've got people that are actually increasing their spending. And we do know that people are running through their seed corn, they're spending through their savings, they're increasing card balances, but it's clear that, there's a lot of people out here that are kind of focused on expense reduction versus those who are focused on actually increasing their spending. And so this is something that we're watching, considering the influence of consumer spending on the total economy, that you have more rationalization, which is going to slow our spending. And we've already seen some of this in the retail sales figure. Here we have corporate profits after tax. And, we've talked about this quite a bit about the health of corporate America. And, as you look here in these after-tax profits, I mean, they're still relatively high. They're certainly off their peaks, but they're, when you look at it on a trend line basis, again, going back to a long time, this is basically 1961 just right here. And where we are, we've come a long way since 2005. But corporate America is in really good shape, all things considered. Some have been able to refinance debt at these much lower interest rates before interest rates went higher. You do see capital budgeting decisions, and there's a chart that we have on that have been tempered as of late. So companies haven't really spent that much or spent as much as they probably need to upgrade their infrastructure. And obviously the economic landscape has been maybe a little bit uncertain, just as we've been dealing with interest rates, inflation, projected growth rates, and been a lot of speculation there. And so companies have held back, but these profit margins are good in that they support stock repurchase, they support continued dividend growth, and other mechanisms to return value to shareholders. Here we have a little bit of an update on money market funds. What's really interesting is we've been watching this whole disintermediation from commercial banks and individual depositors moving money out and putting it into money market mutual funds. And you can see the dramatic rise in balances there. And what you see here is that a dramatic increase in the amount of dividends that are being paid from these funds. And so now that's $500 billion, which is a meaningful amount. And in fact, it's 2.5% of overall annualized consumer spending. And so this has been a fairly dramatic change. What's interesting is we actually saw this run up ahead of the global financial crisis as well. And I'm not saying that this is something that leads to a recession, but it just tends to, again, here in 2000, this is 2019, and even before, as the pandemic was just setting in, I mean, this number was already rolling over, and we still haven't seen, I think, the peak here, and it's a strange cycle coming off of kind of an awkward pandemic situation, but these balances are really high, dividends are high, people are making money from this, and it's putting a little bit more pressure on commercial banks to come up with innovative ways to retain those deposits so that they can continue to make those loans. Interesting chart here from Game of Trades, linking trucking employment to overall private sector employment. And I've never seen this relationship depicted before. And this is actually pretty insightful too, because there is a pretty high level of correlation here. You can see the recession bars in gray. You can see the truck transportation employment in that blue line, which is a little bit more noisy than the trend line in overall private sector employment. But you can see that this is definitely a kind of a coincident indicator to this. And so we see both of these moving down lower. And you see truck transportation actually in the negative right now. And so the case that Game of Trades is making is that this trend line in overall private sector employment is apt to continue to go down because of this tight relationship. Now, whether it goes negative, I'm not quite sure, because there is a pretty decent positive correlation here, but it's not 100%. So you can see there's a lot of variation in truck transport that doesn't necessarily get captured in that overall trend line private sector number. So, but it is something that's worth watching. And like I said, it's interesting in the sense that I've never seen this relationship depicted like this before. Quick comment on single family homes for sale. We do have an interim high. We're the highest point since January 2008. So that is a relatively small part of the overall housing market. We do know the issues incumbent with housing starts, certainly in housing affordability. And so you see a little less volume there on existing home sales, but you do see stick builders continuing to put inventory on the market here, although prices continue to move up, which in fact is a motivation for stick builders to want to continue to build houses. But just know that our inventories available for sale are pretty high right now. On the flip side, we've got commercial construction. We can see here very clearly that these starts have plummeted. Really, you think about all of the various elements of commercial construction. Office is not an overwhelming majority of the overall commercial development. In fact, it's not even a simple majority. I mean, it's a very niche part of the overall commercial market. But you do see a pullback in things like not just office, but you see a significant pullback in industrial. Industrial was very hot a year ago, and even regardless of your geography, and especially here in Central Texas, we had a lot of flex space development, which is kind of semi-industrial office flex space, and you obviously see retail coming in a little bit, but mostly it's the industrial side. But overall, commercial construction starts have plummeted. Some of that has to do with bank financing. Some of it has to do with developers kind of understanding the market and rationalizing their development based on what they see as increasing inventory on the market. This chart here plots the 10-year government bond yield to the US dollar. And again, another one of these charts that has a pretty tight relationship. And you can see here, very clearly that, that there is a long-standing relationship between the dollar and yields. That's not terribly surprising. You tend to see a dollar rising when you have yields that are increasing, and obviously that ties itself back to the attractiveness of having dollar-denominated assets when our rates are higher than other rates around the world. But when you get in a situation where you've got a 10-year that at least over the last month or so has been in a bit of a fall, and you've got a dollar rising, at some point you've got to have a reckoning of this, because this is not typically something that you see happening. And so one of two things is going to happen. Either you're going to have a fall in the dollar, or you're going to have 10-year yields that are going to be rising. And I think the dollar is probably in a stall mode right here. I don't necessarily see the dollar cratering, but I don't see it getting much stronger because of the fact that we've got these yields that are kind of stubbornly lower than what they have been as of late. We have pending home sales. This is a corollary to the chart that I showed you on new home inventory. Affordability is low. You see pending home sales down. You see builder sentiment kind of flatlining a little bit, although builders have a lot of committed inventory that's coming onto the market, as we just saw. But overall housing market metrics are kind of a little bit sloppy right now. Here we have the GDP revisions from the initial report, which we got earlier this year. This is for the first quarter. So essentially, when you get to June, you get the last revision of that number. And so where we are now is negative 2 percentage points. That's quarter over quarter U.S. GDP decline. You see we had positive net exports, and I do believe that's going to slow. We had government spending, which is a little bit slower. Inventory, which were negative. We'll see here that we've got pretty bloated inventories right now, and I think inventories are going to continue to be a drag on economic growth. Housing, which is a modest positive, and then business investment. But you see here this number that kind of is driving the boat right now, and that's consumer spending. We look over here, we get over here and talk about total consumer spending, and again, it's a pretty significant drop off from where we were, and that's why this is fairly negative right here, because this is a revisions from the initial report. So this is basically a revision from what we originally saw when this data was first reported back in April, but from the rate of change when you go from 2023 Q4 to Q1 of this year, you can see that goods spending is in outright decline, and is still buoyed by services spending, and we know that that's where a lot of our inflation is embedded. But you can see the total spending level has clearly come down on a trend line basis if you back out the impact of 2Q of last year. It's a chart from B of A Global Investment Strategy on budget deficits, and we were just talking about this to kind of start the conversation. And you can see here very clearly that you go back to World War One, we ran big deficits, right? Because you're trying to fund a war, fund wartime production. Similar case here. We got to World War II, and then, as some people have termed this is World War WW1, WW2, and then this is WTF. And because we have an expanding economy and have had, if you back out the impact of the pandemic, we've had an expanding economy, but yet we've become much more profligate. And this is what I was talking about initially. These are increases in budget deficits that are really unparalleled in times of economic expansion, where you're not in a wartime economy as you were in these periods of time. And so, we course corrected during the middle of the Clinton administration. Then we had the Gulf War, which needed to be prosecuted here, and then Afghanistan. But then after, these troops are being pulled out, or I guess towards the tail end of those conflicts, you have these things continuing to expand. And this is the issue that I see on the margin as we look over the next 10 years of having the anchors to overall debt burdens and the willingness. It's going to take leadership in Washington to say, listen, these are not sustainable deficits, and we've got to course correct this over time. We have durable goods coming at us. These are more real-time statistics. So you look at kind of what's our health of the economy right now. There's a lot of rhetoric out there. We have somewhat narrow leadership in the stock market, and sometimes you get these kind of like awkward dislocations between what's actually going on in the economy and what's going on in the stock market, but they usually will align over longer periods of time. And so what we're seeing here is we had a surprise actually decline in durable goods orders ex transportation. And if you look at non-defense ex aircraft, that was also down again below expectations. So this is a negative surprise clearly. And if you look at the aggregate line of capital goods orders, non-defense ex aircraft, we absolutely see that flatlining. But when you put it in real terms and you incorporate the effect of inflation, then we actually see real declines in overall capital goods spending. And so this is partly due to corporate America being a lot more cautious. This is partly due to the cost of capital and in some cases access to capital being more challenged than it has been. But overall, this is taken as as basically a negative for future economic growth. Here we have equipment investment and bond yields. And so, we do have here in this green line, this represents high yield bonds. This is actually an inverted scale. So you can see that basically, we have high yield bonds, are compressing. So they're becoming lower because the value of high yield bonds are going up. So those yields are going down, and that's depicted in the green line. This would be when those yields are increasing. Now they're in decrease mode. But what's interesting here, and this is another one of those charts that I haven't really seen this kind of relationship depicted on one chart before, but when you overlay the inverted change in high yield bond yields to business equipment investing, which is on the right-hand scale, that typically when you see bond yields that compress, you see, which is what they're doing now, you see increases in business equipment investing, but right now that investment is still pretty benign. And so the case that this chart's trying to make is that if these yields are going to remain compressed for a while, that you're going to see an uptick in business equipment investing, which, as I mentioned, has been very light lately. Continuing jobless claims, we show you a lot of data on new claims, which comes out every Thursday. What's less apparent here is the continuing claims, and these are long-term claims for unemployment insurance. And you can see that they've gradually picked up here. They're in they've been kind of flat for basically the last year or so with a slight couple week uptick. And so, we're watching this as one of those many proxies of the health of the economy. And so, we have a lot more people than we certainly did, back at the beginning of 2023. That are unemployed for longer, and this goes back to workforce participation. It has a lot of other implications, but clearly something on the labor front that we're definitely in tune with. A couple of regional survey results to report to you. We get these things periodically. This is the Kansas City Fed Manufacturing Index. As we've seen, fits and starts across the country, at least the KC region, is still in the negative. Here we have inventories, as I mentioned before, was a bit of a drag on the most recent revision in the first quarter GDP report. So we see inventory growth still relatively high, both in aggregate terms and in real terms. And so this is what kind of led me to think that, obviously there is demand which soaks up this inventory, but I think these inventories are growing faster than that demand right now, especially when you consider kind of the sluggishness we've had in retail sales over the last month or two, that I think that inventories will continue to be a drag on the economy as we look into maybe the third quarter data, not necessarily maybe even the second quarter, but the third quarter data, because these numbers are moving at such a high clip right now that at some point inventory growth is going to slow and may even become negative. Here we have trade balance. We have had a very strong dollar, as we've kind of talked about. And so what happens with a strong dollar is that your exports become more expensive to the rest of the world. And that tends to slow your exports. And we're still at a point where we're consuming uh, goods from around the world because we seem to be one of the few places that still has some money left to spend. And so what happens in an environment like that is you get an expansion in your trade deficit, which is exactly what we've seen here over the certainly the last year or so. And you can see the fact that we've got basically imports that are moving higher and exports which are flat to lower during this reporting time. As we've been alluding to, economic surprises are turning increasingly negative. You can definitely see that here. There was a period of time where that was becoming a lot more optimistic, but just overall the data is just a little bit more sluggish, and I think that reflects kind of some slowness in the economy that I think is largely not really understood because the headlines seem to be positive, and there still is a lot of very, I'd say, conducive elements to the economy, but clearly there are other elements that are moving sideways to down, and that's captured here in the city economic surprise index, which has turned negative here as of late. We've got real GDP. This is data from Daily Shot. This is just some estimates out there. As we get to this point, we're just in the second quarter. And the numbers, as it were, look okay. Not tremendous growth, and again, growth has been fairly robust as you looked over the last couple of years. And the feeling is, and I tend to agree with this, that things are naturally set to slow down. So when you look at the third quarter, that by this estimate might be our trough, and I think that's consistent with what we're seeing in the data. And then over time, you increase that a little bit, and you get to growth that at a terminal rate when you get closer to 2027 is kind of like right at that 3% level. A little bit more of a near-term basis, we've got the Atlanta Fed, which, as I've touted many times, does a really good job of foreshadowing where the economic growth number is coming in. And this is for second quarter, so right, we're going to get the first reading of this in about 3 to 3.5 weeks. And right now, the blue chip consensus is looking for something around 2%. And right now, we've got the Atlanta Fed, which is looking for something less than 3, but just know that directionally that estimate is coming down. So the more we get in these negative economic surprises, as was highlighted in that Citigroup chart that we just showed you, that number likely comes down to here. And so best guess is that it's going to be 2.5 right now, unless there's more data which would tend to cause us to change that assumption a little bit. This chart, we've got Conference Board consumer confidence data. You can see that number has been sluggish down on a trend line basis over really a couple of years. You can see expectations remain relatively muted. And in this chart, you actually have consumer expectations, a forward look minus your current conditions. And these are two things that are equally measured by the Conference Board, but you can see that right now that we have current conditions which are a lot better than what these expectations are. Again, looking at that, you can see that current conditions, if that's subtracted from these muted expectations, then you're going to get a number that's trending down. And not too surprisingly, when you get this kind of situation where this number is trending down, that you tend to see recessions kind of build around that. And again, I'm not calling for a recession. I'm just saying that these kind of inflection points tend to correlate with economic slowdowns. We got our Philly Fed non-manufacturing, so this would be the service index. So a little glimmer of hope here. We've seen a couple of false positives here. over the last handful of months, and but suffice it to say, services within the Philly Fed district are looking slightly up at this point. We take a look at the Richmond Fed, and we have their own manufacturing index. Again, it's still in sluggish territory. And you look at new orders; those are still sluggish too. I think some of that has to do with kind of that weak capital spending that we were talking about earlier. Although if you have tight high yield spreads, then maybe capex is going to improve at some point, and so maybe these numbers turn up. But just manufacturing for kind of all of the potential inflection points we've been watching for here over the last 6 months, it is still in a bit of a rut. Turn our attention here to housing. We've got the Case-Shiller 20-city composite. We talked about housing affordability being at an interim low, but when we look at prices, we actually had prices in April, which is the last bit of data that we have access to. This tends to come at us at a little bit of a lag, but it was basically almost 0.4%, which was above the consensus estimate. And you can see that number here relative to some of the prior months, it seems to kind of fit right in that average. But we did have basically a clawback after prices went down during the pandemic. Actually, the pandemic was here. Pandemic prices went up, and then we had a kind of a correction of sorts in 2022, and then picked back up in 2023. But that phenomenon hasn't gone away just because affordability is tight. These prices are still moving higher. Some of that relates back to supply and demand, but it is interesting to watch. This chart, we have a depiction of hedge fund managers' exposure to cyclical stocks versus defensive stocks. And what's really interesting here is hedge fund managers are looking a lot more in the defensive sectors. You can see that very clearly defined here over the last several years. And so they're making a bet that these areas that are a little bit more out of favor have a bit more value. We can see the cyclical versus defensive at an all-time low. In fact, we've never seen this. We tend to see, because most of the time we are in a cyclical uptrend, and so you tend to see those stocks achieve a higher overall weighting in hedge fund portfolios. However, of late that has certainly not been the case. We're talking about the election earlier. Something you tend to see in election years is this, which is an increase in volatility as you go from July through the election. I wouldn't be surprised if we did see an increase in volatility. And what are the implications of this type of vol increase? It's just that we tend to have more like 1% daily swings, and that could be a little bit unnerving. Obviously we're watching the fundamental values of the things that we own and looking for areas of really intrinsic embedded value, and those are going to have a lot more staying power amidst an increasing vol environment as we head into November. But I guess the last takeaway from this chart is that you have the election in November, and then you tend to have a drop off in volatility. Of course, that's not an absolute, like if you have a contested election that's got to go to recount, and all the stuff that many of us a little bit older folks remember from 2000, when you have really an undecided election more than a month after the fact. Here we have several charts from B of A equity strategy. You can see here that that we have amongst investment managers. These are not hedge fund managers. These are basically long only kind of traditional investment managers, and they're still overweighted momentum. They're not in defensive sectors. You can see growth at a reasonable price. GARP is well represented, as is overall growth. And then you see risk and value is underweight at this point because people are trying to chase the caboose on the momentum trade. You can see that also depicted here. This is the momentum tilt near record highs right now. So very optimistic fund managers out there. And then you've got value, which is kind of a low PE, high dividend yield. Those are significantly underweight versus momentum right now. So 3 different looks at basically the same story. We have momentum very, very much in favor right now. Another educational chart. I love these. So when you look at, an average day, that you have a 46% chance of negative return over one day. And so if you look at a 1 month, that's 38%. If you look at basically go down here to 1 year, you've got essentially a 1 in 4 chance of having a negative return. So markets are up on average 3/4 of all years, and they're down 1/4 of every year. And but the power in long-term diversification is that if you are invested, and again, this is not even diversified portfolios, this is just the S&P 500, that if you go out and your time horizon is 5 years, then you only have a 1 in 10 chance of having a negative portfolio return. If you go out to 10 years, that's basically 1 in 20. So there is power in long-term investing, significant power in long-term investing, and even more so if you're diversified. And if you introduce something other than the S&P 500 that has a different return set, like fixed income as an example, then you get out here and these numbers are a lot closer to 0. Conference Board consumer expectations for stock prices. This is not an expectation on the economy, but this is the expectation on stocks. And you can see that this has rocketed to an interim high almost. You got to go back to basically 2018 to find a reading this high. And it's just it kind of follows along that feeling that like the economy is witnessing some negative surprises. We're witnessing some slowing in some certain areas in manufacturing, which continues to be sluggish, but yet investor expectations for stock price increases continues to be extraordinarily high. Something else I thought was interesting in the chart pack this week, we've got IT free cash flow yields, which continue to trend down. We've seen a little bit of points of attenuation here. By and large, this trend line, going back over multi-years, is moving lower and lower. Well, we kind of talked about this a little bit earlier, what hedge funds are doing, and they tend to be focusing a little bit more on the defensive sectors, which tend to have a little bit more value. But overall, we see outflows from hedge funds. And we noticed a lot over the last several years. And some funds were fairly flush, but they had trouble making investments and they were returning money to shareholders, and there were maybe less money being raised, perhaps like in 2022, 23. But after a period where we saw a little bit of a reversal in money flows to hedge funds, we've seen that money come out of that sector on a fairly strong basis here as of late. On our last slide of the chart pack this week, we've been talking a little bit about international diversification over the last several months. I actually like valuations. They just kind of lack a catalyst at this point. And but we do care about, the earnings in those sectors. You can see here in emerging markets, we see earnings move higher, Euro area continue to move higher, although maybe at a slightly decelerated pace. And then Japan, which has been a bit of a international darling here over the last year, we see those earnings moving higher as well. So again, I think this helps to build the case for international investing. The multiples on earnings that international markets are trading at relative to U.S. markets, there's still a very wide differential there. And so we are increasing our weight to international markets. This chart tends to corroborate that decision. and at a point where, there's still a lot of domestic earnings expansion capability. We still see that those negative economic surprises, and it kind of informs our judgment as to how aggressive we want to be in the U.S. market. But clearly, these international markets have a lot of value. That is all we have this week. I hope you've enjoyed the chart pack. Have a great week, a wonderful 4th of July, and we'll be back at you next week with another set of charts.